So now we turn our attention to subsidiaries and the income statement. So again, we're looking at acquisition accounting. Now remember, when we looked at the balance sheet, our balance sheet reflected all of the assets and liabilities that we controlled rather than the assets and liabilities that we own. So when we look at the income statement, we're going to bring in 100% of the revenues and expenses from our subsidiary, even if we don't own 100% of the share capital. But what we're also going to do then at the bottom of our income statement is reduce the earnings by any earnings that do not belong to our shareholders. In other words, we're going to have a non-controlling interest, a minority interest in the income statement that essentially reduces the earnings, takes out the earnings that didn't belong to our shareholders. Now again, just like the balance sheet, there's actually going to be three sets of accounts. So again, let's think about our three sets of accounts that we talked about earlier. We have the parent company. Now what are we going to see in the parent company relating to the subsidiary? Well, essentially, we're going to see any dividends that the subsidiary has paid to the parent. So that's going to reflect dividends. We're then going to have our subs accounts, which of course reflect revenues and expenses. But we have no fair market value amortization here. Why? Well, because the fair market value adjustments were made in the group accounts, not the subsidiaries accounts. So when we look then finally at the group income statement, what we're going to see essentially is the parent company plus the subsidiaries' earnings and sales, or let's say earnings. So that's made up of course, revenues and expenses. So we're going to add across line by line. We're going to see the amortization of fair market value adjustments. So again, if you made any adjustments to balance sheet assets and liabilities at the date of acquisition, those adjustments might have an impact on the group income statement in future periods. Now, a classic fair market value adjustment will be adjustments to plant, property and equipment. Remember, when we acquire the subsidiary, we reflect the fair market value of its identifiable assets. Well, the issue is, of course, in the subsidiaries accounts, things like PP&E, property, plant and equipment, will be sitting there typically at historic cost less accumulated depreciation. In other words, they don't reflect fair value. Therefore, at the date of acquisition, we're going to adjust the assets up to fair market value. But that means in the group accounts, the assets of the subsidiary are at a higher value. They're at fair market value, whereas in the subsidiaries accounts, those assets are at, again, as I said, historic cost less accumulated depreciation. Now, because of course the assets are at a higher value in the group accounts, that means more depreciation is going to go through the income statement in the group accounts. So just be a little bit aware. If you make fair market value adjustments at the date of acquisition, those fair market value adjustments may well have knock-on impacts in future income statements. And of course, remember, the final thing that we're going to see in the group accounts are minority interests. So, as we said, we're going to bring in 100% of the sales and 100% of the expenses from our subsidiary, even if we didn't own 100% of the share capital. That means we brought in revenues and expenses that doesn't belong to our shareholders. So what the minority interest does is deduct it. It removes those earnings from our income statement. Well, let's have a look at the steps. So step one, eliminate subsidiary earnings from parent. In other words, remember, in our parent accounts, we're going to reflect dividends that the subsidiary has paid to the parent, but in the group accounts, we're going to reflect revenues and expenses. Subtract the minority share of earnings. Now, as we said, we bring in 100% of the sales, 100% of the expenses of our subsidiary, even if we don't own 100% of the share capital. Therefore, we need to remove the earnings that do not belong to our shareholders. We then combine revenues and expenses of both firms, net of any intercompany transactions. Now, of course, intercompany transactions here would be purchases and sales between the parent and the subsidiary. Remember, we're trying to create the illusion in the group accounts that these were one entity. Remember, we've got essentially the shareholders that own the shares in the parent owns the shares in the subsidiary, and we're presenting the group accounts using the acquisition method as if parent and subsidiary were one combined entity. And therefore, any intercompany sales need to be removed. So we're going to knock out any intercompany sales. And then remember, when we combine the revenues and expenses, we're taking 100% of the subsidiary's revenues and expenses, even if we don't own 100% of the share capital. Now, we've also got a little star here saying only include post-acquisition results. So if you remember, when we were talking about retained earnings in the balance sheet, we said we can bring in our share of post-acquisition retained earnings generated in the subsidiary. Well, it's a similar approach in the income statement. In other words, any results, any earnings that were generated prior to the date of acquisition are pre-acquisition and cannot be reflected in the group accounts. So any sales, any expenses, any earnings, therefore, generated prior to the date of acquisition are not included in the group accounts. Okay, so therefore, when we look at the income statement items, we only include the post-acquisition income statement items in the group accounts. Now, of course, this does mean you get a very distorted balance sheet on the date of acquisition, because when we look at the balance sheet, you've got all of the assets and liabilities of both companies combined together. But when we look at the income statement, we're only seeing the revenue and the expenses and hence the earnings of the parent company, because at the date of acquisition, all of the earnings in the subsidiary are pre-acquisition. So chances are in the exam, if you're asked to produce a consolidated income statement, consolidated profit and loss account, then it's likely that you're going to be doing it at least 1 year after the date of acquisition. Reason for that, of course, is, hey, look, if it's 1 year after the date of acquisition, all of the revenue, all of the expenses in the subsidiary's income statement are post-acquisition. Okay, so let's have a look at our example. Use the following year-end income statements to consolidate the earnings of sub, and look, there you go, 1 year after acquisition. And of course, we've got that statement in there to indicate that all of these items in our subsidiary are post-acquisition and not pre-acquisition. Now, of course, what we're going to do is we're simply going to add across the revenues, so 60,000 in the parent, 20,000 in the subsidiary, giving us a consolidated figure of 80,000 in the group accounts. We're going to do the same for expenses. 40,000 plus 16,000, giving us 56,000. Now, of course, we've brought in 100% of those revenues and expenses from our subsidiary, and hence 100% of its earnings. But we didn't own 100% of this company. We only owned 80% of this company. So therefore, we're going to have to remove earnings that didn't belong to our shareholders. So if we take the earnings of the subsidiary, $4,000, and then say, okay, of those $4,000, 20% was owned by the minorities. 4,000 times 0.2, and that's going to give us our 800 figure. Okay, so that's where that minority interest figure comes from in the income statement. And notice it's being deducted here. We're removing the earnings that didn't belong to our shareholders so that our net income here reflects the earnings that do belong to our shareholders. Okay, so let's have a look at equity accounting for our associates. Remember, when we look at the revenues and expenses, we're seeing only the parent company's revenues and expenses. We then have that one-line consolidation on our income statement, which is, of course, the equity income from associates. Okay, now that, of course, was calculated by taking the net income from the associate, 4,000, and multiplying by our share. Remember, if we own 80%, we're going to multiply by 0.8, and that gives us our equity income. Where in the income statement does this appear? Well, remember, the accounting standards are a little vague on this, but for your CFA exam, you need to assume that it comes in after the tax line, and that's because of a future LOS that asks us to strip out equity accounted investments from the DuPont equation. Anyway, There's our equity accounted investment. Notice we only bring in our share of its earnings, therefore there is no need for a minority interest. Now, under acquisition accounting, when we look at revenues, of course, and expenses, we're seeing 100% of the parent company and the subsidiary company added together. Okay, now that means, of course, we've brought in revenues and expenses that don't belong to us, so then we need to remove earnings that didn't belong to our shareholders. Okay, and that is the minority interest. Remember, that's calculated as the earnings in the subsidiary times the minority's share ownership. But notice, whilst our income statements look totally different under the two methods, the earnings figures are the same. So we end up with the same net income, the same net profit in our income statement.